Hello everyone, welcome back to On the Ledger. This is your host Mol Sayed. Hope you're all doing well as we're back once again on your weekly rendezvous from Paris. Today I'm excited to dive into the world of staking and the wide array of opportunities it brings to organizations and enterprises. Blockchain staking is a fascinating innovation if you think about it. As an investor, you can participate in the operations of the network, guarantee its decentralization, and get rewarded for your contributions. Quite the opportunity. As a matter of fact, the staking industry is expected to be worth $40 billion by 2025. With such potential, there is no shortage of staking solutions currently available on the market, but one critical question arises: how can you stake securely? The answer is simple: you need to retain full ownership of your keys, and that's why Ledger partnered with KILN in Q4 of last year to offer its users the ability to stake ETH directly in Ledger Live from within the security of their Ledger device. But what about corporations? How can staking opportunities be combined with enterprise-grade security and governance? That's exactly what we'll be exploring today with Alex Zinder, Global Head of Ledger Enterprise, and Laszlo Szabo, co-founder and CEO at KILN. Gentlemen, glad to have you on the show. How are you feeling today?
Feeling great. Thanks for having us, Mo.
Yeah, feeling great as well. Thanks for having us.
It's a pleasure. I mean, Laszlo, I would love to set the table here for the, people who are listening to us who might not be very familiar with KILN. So could you give us a quick overview of KILN and its native staking solution? Also, explaining a little bit more how native staking differs from other solutions that are currently available on the market.
Right. So KILN is the European leader in staking. We build different products. We run validators, but we also build aggregators that companies like Ledger can offer staking using different validator provider in the backend. Because the only risk of staking is slashing, and it usually sits at the provider, the validator provider level. And staking, staking is we call it the internet bond. So we think it's the most secure, transparent first yield in crypto, in any proof of stake chains. And the concept is you take your assets, so let's say ETH, you bond it, collateralize it on a validator, and in exchange you validate the transaction, and for doing this work, in exchange you get a yield that is coming from the inflation of the protocol. So every new Ethereum that are being created every year, and the fees of the network. So everyone using the network, NFTs, MEV, will send fees back to the stakers, the one that kind of validated the transactions. So that's what staking is. Staking is not DeFi. It's really important to mention. It can become DeFi when you create a derivative on top. We call it liquid staking. So it's a token. The beauty of staking, it's an amazing yield, but often it's non-liquid, or at least it's non-liquid for a certain period of time. And what liquid staking is bringing is a token that allows you to be liquid instantly. So let's say you stake 1 ETH, you get 1 liquid staking token in return that is supposed to worth 1 ETH. And with this 1 liquid staking token, you can sell it on secondary market, so you be liquid, or you can use it in the rest of DeFi, in Aave, Compound, Curve, and you can stack your yields. So in that sense, liquid staking becomes the first product of DeFi, the first DeFi yield. So yeah, that's the main difference.
That's amazing, and I'll try to unpack a little bit more what you just said here, because there are so many different interesting elements that we need to dive into. So first of all, we all agree staking is a way for any user to be able to participate in the network, participate in decentralization and security, and get rewarded in the form of yield. So that's currently about 4 or 5% on Ethereum, if I'm not mistaken, or maybe slightly more. And the question that people might ask is, why do we need KILN? Why, can't someone just go and stake by themselves?
So first, you need KILN or other companies to run the validators themselves. Okay. So it's a stack that we deployed in cloud providers, so that when you stake your assets, there are actually staked or collateralized bonds on the validator itself, and we doing the work of validating the transaction by signing the blocks. So that's a work that needs to be done by engineers, DevOps, cloud engineers. Second, the product we created with Ledger was much more than just running the validators. It's a fully automated, non-custodial way of staking ETH, so that you can stake now batches of 32 ETH, in the future any amounts, and then the rewards, so that the user keeps his rewards ledger, and KILN as a company takes a commission as well, is done completely on-chain in a non-custodial manner to stay very close to ledger philosophy.
So actually, KILN simplifies the staking process for the average user who doesn't necessarily have the engineering knowledge in order to run their own validator, which is basically like a computer that validates certain blocks and keeps track of the ledger. Makes sense.
Yeah, quite a
AZ.
bit. Yeah, let me jump in here because I was listening to Laszlo, and he's incredibly knowledgeable in the space, and he really understands the crypto native aspects of staking and proof of stake and DeFi. So it's really, to me, fascinating to see how somebody with that level of knowledge around the emerging crypto ecosystem and DeFi describes some of these concepts. And I think it's also interesting to highlight, we've seen that there's been a lot of regulatory noise and concerns around staking in the recent past, and it's very important to highlight a couple different pieces. So I'm going to take a little bit of a traditional financial outlook and unpack some of the terms that Laszlo uses very well. So it's very important to understand that when we say bond, right, in the traditional financial sense, that is a known term for a financial instrument, right, that is able to generate yield in return for you to allocate your assets, or letting somebody borrow your assets towards a productive outcome. Right, so bonds are generally long-term investments. Everybody knows, treasuries are bonds, right? You can create bonds to fund very long-term, large-scale utility projects like energy grids, for example. And it's a very purpose-built financial instrument that is quite widely used and very productive in the traditional financial sense. But it's also important to understand that when we use the word bond in the context of staking and in the context of crypto, right, all we're saying and all Laszlo is saying is that this is a technical bond, right? So you're creating a technical instruction on a distributed network, which is a proof of stake network, that allows that network to leverage your assets to protect itself, right, and power its own operation. And that's the basic premise around proof of stake. And the network is designed in such a way where it offers financial incentives for people that are interested in participating in the operation of that network. This is how it works. So it's very important to distinguish the technical aspect from the financial aspect. And I think it's also very important to understand that the existence of somebody like KILN, and the reason why Ledger made decisions to create joint offerings towards our retail and institutional audiences around staking, is that I think we're aligned with Laszlo and the KILN team that staking is a technical capability, right? And as long as we are in a position to offer it as a technical capability with self-custody, right, and with DeFi type functionality, right, where you're not introducing another financial entity to pool assets, to manipulate assets, where you're basically creating a fully technical, secure, governance-based solution to offer users, be that retail users or institutional users, to commit their assets to the protection and operation of a specific network, right, and generate rewards as a result of that, also without an intermediary, right? This is a DeFi-based crypto-native solution that does not require a financial, a financial structure behind it, and that is a very important distinction. And this is really why we're kind of moving in this direction, and we're working with the partners that we're working with Ledger. The critical piece here to understand is that if you stake with self-custody, where you still own the keys and you still own the assets, and you stake with a provider like KILN that has the full technical capabilities to be able to properly do this on any network, because the rules are varied and in some cases quite complex, but do it in a technical way where you're interacting with a smart contract and you're using all the right rules of a network, then you will avoid running into regulatory challenges of what happened with Kraken, for example, right? Because there is no person or company in the middle creating the pooling and manipulating your assets on your behalf. And I think this is important also to know that this applies to both retail users, ledger users, not your keys, not your coins, and institutional users. So self-custody as the concept also applies on the institutional side. And Ledger also offers custody solutions to companies and large organizations and institutions that enable them to stake with self-custody without introducing an intermediary. And KILN is extremely well positioned to offer the low-level technical network functions, fully automated and fully technical, to provide non-custodial staking capabilities, both individuals, right, smaller sizes, larger frequency, more scale, and institutional.
That makes a lot of sense. Thanks for clarifying, AZ. And I think that's a very important distinction, because a lot of people might not understand the difference of staking on an exchange. For instance, you mentioned Kraken, but there are a variety of other exchanges that offer staking solutions, and staking in a non-custodial way, so by self-custodying your assets
And
owning
maybe
the keys.
just to jump here on the Kraken example, because I think it's a really good example. If Kraken would have used a solution provided by Ledger Enterprise and KILN to basically manage all their staking operation on chain in a fully transparent way, no opaque governance, maybe the SEC would have looked at this product very differently. And so obviously right now we're offering our products with Ledger for retail users on the live, but if you are an enterprise as well, if you're an exchange, you might want to switch your staking operations from this opaque, we call it omnibus. So, you put a lot of different funds in one wallet, and you don't showcase that transparently to the user, while just doing it completely on chain in a non-custodial way, fully auditable, using Ledger Enterprise Custody and our solution via our smart contracts.
Exactly right. So it really, to Laszlo's point, it really comes down to the how do you implement it and how you manage your users' assets and how you offer these types of services, where these distinctions are going to be hugely important and differentiating. And frankly, like there's no blame here, right? There's been no regulatory guidance, right? These are very difficult and painstaking technical capabilities that take a very long time to develop, right? So people create models that help them scale those capabilities, and in some cases, those models take some shortcuts, right? Not necessarily exposing people's assets, but there's different touch points. So we're really together with KILN and others in the business of providing the right tools to empower organizations to create staking solutions properly, right, in the correct way, where the user is completely protected, right? And we bring the highest level of consumer protection into the ecosystem. So that combination of ease of use and ease of adoption with the right scalability and governance capabilities is going to be critical moving forward.
That's a really great point. And you did a pretty good episode on Ledger Enterprise a few weeks ago with Ian. But for the people that haven't listened to this episode, what's the difference between Ledger Enterprise and Ledger products? We talk about governance, but what does it mean?
Yeah, no, that's a great question, Mo. So I think the way to describe it very simply, hopefully the audience understands Ledger and the Ledger Nano and the concept of self-custody, right? So about 8 years ago, Ledger solved a very fundamental challenge in the crypto ecosystem. We created a hardware wallet that does really two things. It secures your keys, right? And then it provides you a secure interface and secure compute capability to sign transactions with those keys without the keys ever leaving the device, right? So we're completely isolating your private key materials, right, which is critical. But we're also offering you what you see is what you sign capability, where on the device, you see exactly what transaction you're signing and how you're interacting with the network. That eliminates any man-in-the-middle phishing attacks and completely isolates and protects your private key materials. Those are, very simple things, but very difficult to solve in a scalable model. So Ledger was very successful in that, and that shows by the adoption of the Ledger hardware wallet that we've seen with over 6 million devices sold and securing a very large percentage of crypto globally. But that does come with a certain challenge, right? Is that the Ledger hardware wallet was designed for a single user, one person, right? One Laszlo, one device, one key phrase, one set of keys, full self-custody. Laszlo can grab it with him, put it in his backpack, take it on a plane, right? He's the only one that knows the PIN, and he has full sovereignty over the assets associated with that wallet, which is great. But the challenge is Laszlo runs a company, right? He is not just touching his own assets. And as much as a great CEO Laszlo is, he frankly shouldn't want the accountability and responsibility of holding all of his company's assets on his Nano, where he knows the PIN and there's no checks and balances and governance framework to be able to do so. And his shareholders probably also don't want that, right? And right now, that is not a problem that you can solve for with a Ledger retail wallet. But it is a problem that you can solve for with the Ledger Enterprise B2B solution. So we designed a solution that has the same concepts. It's still self-custody. We still secure your private key materials. We still provide you with secure compute and the secure screen to do what you see is what you sign across a wide range of different operations. But we do so in a way where we empower teams to execute transactions with operational governance, clear and segmented workflows, and a very wide range of scalability factors, right? So companies like KILN process hundreds, if not millions of transactions on behalf of their users or to support their use cases, right? They need reporting, they need governance, they need to report to regulators, they need to report to their clients, they need to operate their business at scale, and they need to have teams of users that are able to do that. And all of that needs to be coordinated with governance, controls, security, right? So that they have full predictability and full operational control of their crypto assets. Mm-hmm. And that's exactly the platform that we build. So it's security with securing your keys, operational governance, full reporting capability. And through that framework, what we do is we open up the capabilities to do multiple interactions with blockchains to create the right use cases, right? Mm-hmm. So whether it's DeFi, staking, send, receive, treasury management, NFT management, very different use cases and very different interactions with the blockchain. Same governance, same security, same framework.
So that's kind of enabling the enterprise on an enterprise level to be able to interact with the world of Web3, benefit from all of its services, while having the security of the Ledger Nano and the governance model that enables you to become so much more redundant in how you manage the treasury of a company. And Laszlo, before we deep dive into like KILN for Ledger Enterprise, actually it started off with Ledger Live in Q4 of last year. And it's fair to say that despite the 32 ETH minimum threshold, it has been a massive success. To date, if I'm not mistaken, there are more than 1,500 validators taking about 55,000 ETH, which is about $88 million. Amazing, to be honest. I'm wondering first, why the 32 ETH threshold and multiples?
Just on the previous question as well, I can mention that my investors and colleagues are happy that I'm not putting all the company's transaction in a simple Nano in my backpack, and I applied governance to it. So in that sense, Ledger Enterprise solve a big problem for companies. Coming back on the Ledger Live product that we launched, I think so. First of all, why 32 ETH, right? It's a technical issue, or at least a technical criteria on the protocol. You have two different kinds of staking protocols. One, they call it delegated proof of stake, where you can stake as much as assets on a single validator. So let's take, for example, Solana, where you have 2,000 validators on the network, and you can delegate any amount of SOL you want on a specific on one machine, on one validator that is deployed in a cloud provider. Ethereum has this concept of pure proof of stake. The reason for that is that they want to keep the architecture of the protocol as decentralized as possible. So any 32 ETH, you have to spin up a new validator on the network. So the main reason why we launched first batches of 32 ETH for the user, it was because it was for us simpler to launch as a first product on Ledger Live. Also because there's a lot of big Ethereum holders, using Nano, so we were kind of confident that this product would have been a success. And as you mentioned, 55,000 ETH staked in a couple of months. We think that's quite a success. And yeah, going forward, maybe more you, Alex, and myself would be even happier if we can stake any amount of ETH using a Nanos via the Ledger Live. So we'll launch pooling actually in less than 2 months. So you will be able to stake any amount.
Amazing.
That's the second version of the product we're launching on the live.
I think a lot of people will be happy to hear that. And something that's currently in progress, I would say, is the Shanghai Upgrade, which will enable validators to withdraw ETH staked as far back as December 2020, when the Beacon chain was first launched. How do you think that'll impact KILN and the ETH staking industry in a more general sense?
Yeah, I think it's going to be a massive change in the ETH staking ecosystem, in the Ethereum ecosystem in general. As you mentioned, the Bitcoin chain launched, so you were able to stake since December 2020. Right now, you have approximately 15% of all ETH supply that are being staked. We think at maturity, it's going to go up to 60, maybe 70%. If you look at other very mature proof of stake networks, such as Solana, Cardano, Polkadot, this is kind of like the ratio we are seeing. The reason we haven't reached this ratio is that today and until Shanghai, you weren't able to unstake your assets, right? Because of security reasons, because obviously we had to see the merge happening, transitioning from proof of work to proof of stake, and then many other kind of little updates that will actually happen during Shanghai. So during Shanghai, you will be able to finally unstake your 32 ETH plus the rewards that are on the execution layer, which actually you were already able to do, or the consensus layer. You will be also able to maybe just take the rewards and not unstake the whole. So let's say you have, 34 ETH on the validator, 32 plus 2 ETH of rewards. You'll be able to take the 2 ETH and keep the validator running on the 32. And yeah, because of that, because of this liquidity, we expect a lot of ETH being staked quickly after Shanghai. We did a survey with 100 major institutions, some using Ledger Enterprise, of how they will be willing to stake the asset after Shanghai. And I think 68% mentioned they will stake after Shanghai. 70% of this 68% will say we want to stake a few weeks after. So yeah, we really expect to see a lot of demand for e-staking after this event. It doesn't mean that you will be able to unstake your asset instantly, right? There's still, we call it the security queue. So when you want to unstake your assets, you have to enter the queue, and there's 1,500 validators that can be unstaked per day. So if there's a lot of validators that want to unstake it after the event, maybe the queue will take a few weeks, but obviously still much better than before. You will be able to finally be liquid.
Makes sense. Alex, what's your take on that? Do you think, institutions will have now the right infrastructure and the incentive to start staking more ETH? Are you seeing more traction on your end?
100%. 100%. I think adoption is going to really skyrocket. We're super bullish overall on proof of stake as a concept and proof of stake networks and protocols. We offer a wide range of staking capabilities across different protocols, but I think obviously Ethereum, based on its size and adoption levels and the overall weight of the community, is being watched very closely, and I think it's a very big opportunity both for Ethereum and the crypto ecosystem as a whole. Honestly, I have to be very, I'm very confident that the indicators that we've had as to how this whole transition has been handled by the network and the developer community this is a very difficult thing to do and execute, and it's been managed incredibly well. And we have very high levels of confidence that the transition is going to go smoothly. And it does open up a very significant opportunity for institutions to really step in and participate in the community and provide the right services for the Ethereum ecosystem to be able to continue to scale and offer a wide range of different utility use cases. For us, and then for me personally, I've been kind of observing this space for a long period of time now. This is really the right step in something that I like to call a shift from speculation to value creation, right? And this is what we've been observing as a whole, and I think that the market is actually starting to really represent that movement. A lot of the activity that we've seen historically in crypto has been speculatory in nature. And there's absolutely nothing wrong with that, right? It's just the way that the industry has evolved and developed from a financial services perspective. But the exciting transition for us, being a company that invests in technology and security, is the broadening of that speculatory capability into real long-term value creation utility use cases. And I think there's a lot to be said in the combination of the developments in the NFT space, the entrance of some of the larger corporate players into the ecosystem. Look at Nike's success. Look at what others have been doing in this space. We just had a Salesforce announcement. So there's a lot of really big names, Fortune 100 companies coming into this space and really unlocking utility for their users and for their retail audiences, leveraging some of these distributed technologies. And I think, in my opinion, the movement to proof of stake really highlights the opportunity for these guys to come in and also invest and contribute to the operation of the network that they're using to support their users. Right. And that's 100%. Going to be a really critical difference. It's not about trading, right? It's not about, price discovery and market making across exchanges. Those things have to exist. Those types of financial services have to exist. DeFi needs to continue to flourish, but it now has a real reason. And the real reason is the utility use cases that will support millions of users with NFTs, with token gating, with wide range of identity use cases that we haven't even envisioned. And having the ability to invest alongside the creation of the utility capabilities into proof of stake models, right? And allowing larger companies to manage their treasury with staking as a component of that treasury management is going to be very critical.
It's such a value unlock when you think about it. Like, aside from all of these corporations and brands entering the space to expand their product line with digital collectibles and digital assets, if you add staking on top of it, it just starts making a lot of sense. And speaking about that, to your point, we're seeing Nike, we've seen, Starbucks, we've seen almost every single luxury brand or fashion brand out there thinking about how they're going to be making their first moves into the space of digital collectibles and Web3. It kind of reminds me of the, on a much wider and more amplified scale, the digital transition, from Web 1 to Web 2, and now is the transition from Web 2 to Web 3. What do you think those different corporations need in order to successfully achieve their Web3 transition? Obviously, there's the infrastructure, but I assume there's a lot more than the infrastructure that is needed for that transition.
100%. There's still a lot that needs to be done. We're still very early on in the adoption cycle, and but the trends that we're seeing are hugely, hugely positive. I think one thing I wanted to make sure that we make an important connection here, because we are talking about staking, is that I think the fundamental shift, and we need to continue to invest in education to make sure that the entrants and the larger corporates really do understand that paradigm shift, and then the retail user base at scale starts to really understand the paradigm shift. And that shift is very simple, right? The security of these networks, specifically when we're talking about proof of stake, is directly correlated and dependent on the value that is locked into the networks themselves, right? And then secondarily, the security is also dependent on the distribution of that value, right? And not the concentration of it. And that's an important thing to highlight, right? A lot of the critical failures that we've been seeing over the last 6 months, and now also in the traditional financial ecosystem in the US, which has been amazing to watch, has been due to centralization of risk. Right, that was the primary driver with FTX. That's been the primary driver with the bank runs that we've been seeing in the U.S., and that's the primary catalyst for regulators now taking a much more serious look. In fact, the education has come so far that the regulators are saying, "Hey guys, the promise of crypto was distribution. The promise of crypto was DeFi. Please do not use it as a mechanism to circumvent regulation and offer centralized financial services on top of crypto assets," right? That is not going to fly. Which to me and to Ledger and to KILN, I'm not going to speak too much for Laszlo, but I assume he's a client there. This is the right momentum, right? That's the right vision. We need to preserve the concept of self-custody. We need to continue to educate the retail user base. The guy that's going to, buy his next Air Jordans with an NFT pre-pass, right, needs to understand that if this thing represents value to you as an individual, you should invest in self-custodying that value, right, and distributing and managing and owning your own risk. And your own custody and your own value capabilities. And that same concept applies to the major brands and organizations. If you're going to offer those services to your very valuable retail users and you're going to put your brand on the line, right, because you want to offer them a good service, because there is the brand association that's there, you also need to take your own custody and governance and capabilities into your own hands, and make sure that you're doing that correctly, and you're contributing to the networks that you're leveraging to execute these types of use cases. You're participating in the community, and you can do that with staking, and you can do that with self-custody, and not just delegating that responsibility to a financial institution like a bank.
Absolutely. Laszlo, what's your take on that?
No, it's a very good point. I couldn't agree more. We had this discussion several times with Alex, over coffee in Paris, and I think we always had the kind of the same vision there. What traditional finance brought, and the limit of it, the crisis, and what we've seen with the recent bank run that you were mentioning, Alex, is really opaque governance of money management. Is really about centralized failure of several humans using this money in not the right way. And what staking and also DeFi, there's not only staking is bringing, is really this decentralized way of governing money, this transparent way of showing to the user what's actually happening to the funds that they have staked or they have collateralized in any DeFi pools. And I think, I think it will completely change the financial industry, and not trying to come back to past models using sometimes centralized vendors that are just new banks handling your crypto for yourself, not your keys, not your coins. So I'm pretty sure we'll see other products right now on staking, but in the future around DeFi as well, because DeFi brings transparent, secure, and great yields in crypto. We'll launch different products with Ledger Enterprise. for these institutions to be exposed to the safest and most transparent yield. You were talking about NFTs as well. You can see the problem of when you, I mean, the good thing of staking a validator of 30 ETH is that you have one validator that is deployed somewhere. It's very close to the protocol. It's less risky than some liquid staking products. But still, when you stake your assets, as I mentioned, you have to wait for the exit queue to happen. So we are working on a product with Ledger of generating an NFT to represent this validator. So this NFT will maybe enable you to put it on collateral in DeFi. So you have your validator of 30 ETH that is earning yields, putting on collateral in DeFi, or just sell it on different NFT marketplaces. So you can have instant liquidity instead of just waiting for you to stake several weeks in the queue. So that's also a product we're going to work together with Ledger. But again, in the same vision of let's reinvent the financial industry, let's make it more decentralized, let's make it more transparent, and let's make it non-custodial in so many aspects.
That's actually a great point. I think transparency is such a core value proposition that's so strong within the space. I was actually listening to Jeremy Allaire on Bankless right before we started this podcast, and he said something that really resonated with me, which is that now we're getting to a place where instead of crypto being a systemic risk for the traditional financial world, it's kind of starting to be the other way around because of that transparency that we can really check and understand the reserves of these different institutions and protocols, and hopefully that will also enable us to start creating solutions that target these different friction points that we're seeing. And that's definitely something that a lot of people have realized after the current crisis that we're currently going through.
100%, Mo, and Jeremy is brilliant in this regard.
Amazing.
I love having those conversations with him, and it's very important that you highlight this because, a network is only as sound, right, and only as reliable as its weakest link. Right, and that really is a fundamental challenge that we experience, and this is why Ledger and players like KILN are fully committed to offering services and technical capabilities to make sure that the weakest link is strong, right? And we're leveraging the right technology to empower people to build the best use cases, leveraging the right network capabilities, and making sure that in the process they provide the best possible consumer experience and consumer protection to their user base, right? And those are critical aspects. It's what we do every day. Right, and we've been talking about this for a while, and this is why we will always continue to be a security and a technology company. We're not in this to make a quick buck, right, and turn over some Bitcoin and build some financial services where people make some yield, right? We're in this to build sound technical capabilities that support the development of these networks and these ecosystems for the long term. And it's brilliant for me to be working with partners like Laszlo and KILN to make steps and big strides to see these networks flourish, right, and see the capabilities that we bring to mass market.
So what does the near future look like for you guys? What's on the roadmap?
As I mentioned, the beauty of working with Ledger, frankly, I have to say, since a year and a half now, and a lot of team members on both sides, is that we have been building unique, incredible products, always going towards offering the best transparent yield, decentralized to our users, is a retail institution. So the future is we would love to launch new features, as I'm saying, pooling on Ledger Live, or NFTs for those that have staked 32 ETH. So they maybe can seek early liquidity or composability in DeFi with this NFT. Maybe even thinking of, as I mentioned earlier, different products around DeFi. Staking is the first yield, but then you have a bunch of other yields that are transparent and secure as well in DeFi. And we've been thinking about that for several months with Alex. Bringing that to a billion users, right? I would love to see Nanos or at least Ledger products in the future, could be Nanos or anything, to billion users, and I would love to see these users using staking and DeFi yields through the Ledger Live and through the Ledger products.
Thank you, Laszlo. I couldn't have said it better myself. I think, very clearly we're continuing to work towards improving the user experience and grow the adoption, right? So self-custody for individual users, for retail, self-custody for companies and organizations through B2B, and working and building with partners like Laszlo and with our customers to make sure that we're in the best position to empower crypto companies, both crypto native and new entrants, to bring the best possible experience to the crypto user community, right? And bridging that gap between the two is the most exciting thing that I get to do every day, which is amazing. And working with partners that help us unlock that capability, like Skills, is super rewarding.
Amazing. So before we wrap up, I'd like to ask you a question. Imagine you were able to solve one challenge related to the Web3 and blockchain ecosystem in the snap of a finger. What would it be?
That's a hard one. I can start. I think at some point, maybe 1-2 years ago, was scalability was a big thing, but now I see a lot of L2s, interesting products around Ethereum or other chains. I don't know, Arbitrum, Optimism, Starkware. I think we're getting there. I guess the next big challenge in the next year, 2 years, 3 years is getting more and more users in Web3 without sometimes users even realizing they use the security and the centralized aspects of Web3. So UX is a big thing. Making users access these apps with a simple password as they used to in Web2. Great password recovery instead of like using the 24 words. And I know, you at Ledger, you're working on various different products again to get this billion users to access Web3 in a secure way. So I'm pretty sure you will launch exciting products on that front. But yeah, UX I think is one of the main biggest challenge that still remains to be solved, and I'm confident that it will be solved in coming years.
Yeah, I would say, to kind of state your governance requirements, Mo, one thing would be scale. Okay. Right? Scale is the one critical variable that we need to solve for, but we need to do that securely, with the right governance, with the right capabilities. And the biggest blocker for me, so the one thing that I would say if we could solve for, then we can achieve scale, is education and awareness. Right? And the basic premise is the tools exist. We know because we built them. Make sure that the world understands that and starts to use them actively. Then we can get secure scale and adoption at scale.
Perfect way to end it. Gentlemen, it's been a pleasure. I'm very much looking forward to the future of KILN and Ledger, both of them together, solving security, governance, and scalability solutions and adding value to the overall ecosystem.
Thanks so much for having us.
Thank you, guys. Pleasure as always.
That's it. Staking is clearly one of those fascinating innovations that align stakeholder incentives to add value to the overall network, all while simultaneously strengthening it. And Ledger Enterprise is glad to be accompanying you along its way. On the Ledger, we'll be back soon with some of your favorite content. In the meantime, stay safe. Till next time, au revoir. This content is provided for informational purposes only and is the sole expression of our opinion and should not be relied upon as legal, business, investment, or tax advice. Do your own research. Any loss or profit is your sole responsibility. Stay safe.